Every April, Americans hand over roughly 25% of their income to the government, while a small group of informed people legally pay zero. What you're seeing aren't billionaire tax returns. These are regular Americans, a teacher, a nurse, a marketing manager who discovered something the tax preparation industry desperately hopes you never learn. The difference isn't that they earn less or hide income offshore. They understand a truth that H&R Block, TurboTax, and most CPAs will never tell you. The tax code isn't just rules to follow, it's a game designed with intentional exits for those paying attention. I'm about to share the 5 most powerful and accessible tax elimination strategies that work for ordinary income levels. These aren't gray area schemes. They're legitimate provisions that Congress created deliberately. The tax preparation industry generates $15 billion annually. Their business model depends on you believing that tax planning is impossibly complex and that paying substantial taxes is inevitable for middle-class Americans. While the tax prep industry profits from your confusion, informed Americans use these same legal strategies to eliminate their tax burden entirely. Strategy 1. The 0% secret. The first strategy is what I call the 0% secret, legally paying zero taxes on investment gains by understanding income thresholds that most Americans completely ignore. Here's something the investment industry doesn't advertise. If your total taxable income stays below specific thresholds, $94,050 for married couples or $47,025 for singles in 2025, you pay 0% tax on long-term investment gains. Not reduced taxes. Zero taxes. What most people do: sell investments randomly throughout the year without considering tax implications. What smart people do: strategically harvest gains during lower income years while staying under the 0% threshold. Here's how powerful this is. Tom, a teacher earning $45,000 annually, had $40,000 in unrealized stock gains. During his summer break with no teaching income, he strategically sold $30,000 of those gains. Because his total income for the year stayed under $47,025, his entire $30,000 gain was completely tax-free. That's $4,500 in taxes legally eliminated. Modern investment apps like Fidelity and Schwab now track your gains and tax implications in real time, making this strategy easier than ever. You can literally watch your tax bill disappear as you plan your sales strategically. Strategy 2 is tax-free real estate profits, potentially the most accessible wealth-building strategy for average Americans that the real estate industry barely mentions because it doesn't generate commissions. Your primary residence isn't just where you live, it's a tax shelter hiding in plain sight. Married couples can exclude up to $500,000 in profit from home sales completely tax-free. Singles up to $250,000. And you can use this benefit repeatedly every 2 years, while profits from rental properties get taxed at capital gains rates up to 20%, plus potential depreciation recapture. Your primary residence profits are completely tax-free with proper planning. The qualification requirements are straightforward. Here's a real example. Sarah and Mike bought their first home for $280,000 in 2020. After living there 2 years and making $25,000 in improvements, they sold it for $420,000 in 2022. Their entire $140,000 profit was tax-free, saving them approximately $21,000 in federal taxes. They immediately bought a $480,000 home using their tax-free profits as a down payment. After living there just over 2 years, they sold it for $650,000 in 2024. Again, their $170,000 profit was completely tax-free. In just 4 years, they built $310,000 in tax-free wealth. If they had done this with rental properties instead, they would have paid approximately $46,000 $500 in capital gains taxes. Implementation keys. Document your primary residence status carefully. Keep voter registration, utility bills, bank statements, and homestead exemption records. The IRS rarely questions well-documented primary residence sales. Strategy 3 is the business expense transformation, legally converting your personal expenses into business deductions, even if you're currently a W-2 employee with no business experience. Even W-2 employees can establish legitimate side businesses with minimal startup costs. The key is genuine business intent. You must actually intend to make a profit and operate like a real business. Legitimate business ideas. Freelance consulting in your field, e-commerce selling, content creation, tutoring, photography, home services, affiliate marketing. These require minimal capital, but create legitimate business deduction opportunities. Jennifer, a marketing manager, started a weekend consulting business helping small businesses with social media. She legitimately transformed $8,500 in existing expenses into business deductions. Home office, $2,400 annually. Vehicle expenses, $3,200. Business meetings and client visits. New laptop and equipment, $1,800. Business meals and networking, $1,100. At her 24% tax bracket, this saved her $2,040 in taxes annually while building a side income stream. Critical requirements for success. Separate business bank account. Essential. Detailed record keeping of all expenses. Document business purposes for all deductions. Actually pursue business activities and income. Don't claim 100% business use of personal items. Strategy 4 is retirement funds without restrictions. Accessing your retirement money completely tax-free at any age while building a permanent tax-free income stream that lasts forever. This strategy is called a Roth conversion ladder. Here's how it works. During years when your income is low, you convert money from traditional IRAs or 401ks to Roth IRAs. You pay taxes on the conversion at your current low tax rate. Then, exactly 5 years later, you can withdraw those specific converted amounts completely tax-free, regardless of your age. Here's a real example. Mark lost his job at 45, but had $600,000 in his traditional 401k. Instead of panicking, he implemented this strategy. Each year, he converted $35,000 to his Roth IRA, keeping his total taxable income in the lowest tax brackets. After 5 years, he began withdrawing his first $35,000. Conversion completely tax-free. The next year, his second $35,000 became available. By year 6, he had a perpetual stream of $35,000, 0 cents annually, in tax-free income, decades before traditional retirement age. The genius of this strategy is timing conversions during low-income years, between jobs, during early retirement, business loss years, or when you can control your income timing. You pay taxes at the lowest possible rates to eliminate taxes forever. Advanced strategy. By converting different amounts each year based on your tax bracket capacity, you can create a customized tax-free income stream. Convert $20,000, 0 cents, 1 year, $40,000, 0 cents the next, based on what keeps you in low tax brackets. Key rules to remember. 5-year waiting period for each conversion, not cumulative. Can only convert after money is in traditional IRA, may need to roll over from 401k first. Pay attention to pro rata rules if you have both deductible and non-deductible IRA money. Consider state tax implications of conversions. Our final strategy is the millionaire's stock secret, potentially excluding up to $10 million, 0 cents, in stock profits completely tax-free, through a provision that most investors and even financial advisors never discover. Section 1202 of the tax code allows you to exclude up to $10 million capital gains from qualified small business stock sales completely tax-free. This isn't just for Silicon Valley venture capitalists or people with millions to invest. You can participate with investments as small as $1,000, or even better, structure your own business to qualify from day one. The key is understanding the specific qualification requirements and planning for the 5-year holding period. For stock to qualify, must be C corporation stock or LLC electing C Corp taxation. Company must have gross assets under $50 million, 0 cents when you acquire the stock. Must be an active business, not passive investments or certain service businesses. You must hold the stock for at least 5 years. Stock must be acquired directly from the company, not on public markets. Here's how accessible this can be. Lisa invested $5,000 in her friend's qualifying tech startup in 2019. The company developed software solutions and grew rapidly. In 2024, after holding for over 5 years, she sold her stake for $125,000. Her $120,000 gain was completely tax-free under Section 1202. If this had been regular stock, she would have paid approximately $28,800 in capital gains taxes. Instead, she paid 0. Implementation steps. Verify the company qualifies before investing. Get proper documentation of your stock purchase. Track the 5-year holding period carefully. Consider this for your own business structure. Modern platforms like EquityZen and Forge now facilitate these investments. Implementation priority guide. So which of these 5 strategies should you implement first? The answer depends on your specific situation, but here's how to prioritize for maximum impact. Start today's strategies. If you have any investments, implement the 0% capital gains strategy immediately. Review your current holdings and plan strategic sales during low income periods. If you're employed, begin the business expense transformation by establishing a legitimate side business. Even a simple consulting or e-commerce business can transform thousands in personal expenses. 6 to 12-month strategies. If you own a home, start planning your primary residence strategy. Document your resident status and consider your 2-year timeline for potential strategic moves. If you have retirement accounts, begin planning Roth conversions during your next low-income period, job transitions, business down years, or early retirement. Your tax-free future. Imagine keeping an extra 25-37% of your income every year through these legal strategies. For someone earning $75,000, 0 cents annually, that's $18,750 to $27,750 in additional wealth yearly. Over 20 years, those tax savings invested at average market returns become an additional $800,000 to $1,200,000 in wealth. This isn't just about saving money on taxes, it's about accelerating your path to financial independence by years or even decades. More importantly, you break the cycle of financial ignorance. You now understand that paying substantial taxes is optional for informed Americans who understand how to use the tax code strategically. Your next steps are simple. Choose the one strategy that best fits your current situation, implement it properly with appropriate documentation, and measure the results on your next tax return. These aren't loopholes to exploit. They're incentives that Congress wrote directly into the tax code. By using them, you're not gaming the system. You're using it exactly as designed. Which of these 5 strategies will you implement first? Share your choice in the comments below. Hit the like button and subscribe for more strategies that help you build and preserve wealth. This is Wealth Leverage Lab, turning financial knowledge into financial freedom.